Hey everyone, we need to talk about what just happened to silver. In the last 24 hours, silver slid down to about 81.95 an ounce. That's roughly a 2.5% drop in a single day. And in dollar terms, that's about $2.21 per ounce. Now, if you own 100 ounces, which is not crazy at all for a lot of people watching this, that's about 220 bucks that just vanished in a day. And gold? Gold is down too, but not even close to the same kind of hit. Gold's sitting around 5,051, and it's only down about 0.6%. So here's the real question. Why is silver getting punched in the face, while gold is basically just taking a step back? Because this isn't just metals are down. This is a very specific kind of move, and if you understand what it usually signals, you'll see why the next few sessions could matter way more than people realize. What you're seeing isn't the mainstream explanation, and I'll keep it simple. Here are the three factors that converge today. First, silver is not just a money metal. It's also an industrial metal. That sounds obvious, but most people don't actually trade it that way in their head. Silver gets treated like gold when everyone is scared about money printing or inflation, but when the market starts sniffing out economic slowing, silver often trades like a growth asset, meaning silver can get sold like it's a factory input, like it's copper, like it's demand sensitive. So when silver drops harder than gold, one message the market sometimes sends is this: we're nervous about growth, not guaranteed, but that's one of the classic tells. Second, silver is thinner, more emotional, and more levered than gold. Gold is a bigger, deeper market. When people move serious money, gold can absorb it. Silver can't absorb it the same way without violent swings. So when you see silver down 2.5% while gold is barely down 0.5%, it often means one of two things is happening. Either silver is leading a broader risk-off move, or silver is getting hit by forced selling. Margin calls, stop-loss cascades, traders who are too confident getting flushed out. And here's the part most people miss. Those flushes don't always happen at the end of a move. Sometimes the flush is the beginning of the next phase. Third, the psychology around levels matters more than people admit. Silver in the low 80s sounds high because it is, but markets don't care about what sounds high. They care about what's crowded. If too many traders were leaning one way, expecting silver to keep grinding higher, it doesn't take much to trigger a fast downside move. That's how you get a drop that feels sudden and unfair. And when it happens, the biggest mistake people make is assuming it's random volatility. It's usually not random, it's positioning getting punished. Now put those three together: industrial fear, thinner liquidity, and crowded positioning. That's how you get a day where silver looks like it's in trouble, even while gold is still acting relatively calm. And that's why I'm taking this seriously. Now let me walk you through how I'm thinking about this, and I'm going to do this in a way you can actually use. No hype, no drama. Just a clean framework. Smart money moved before the crowd noticed. And the way you can often tell is by watching the relationship between gold and silver. When both rise together, that's usually a broad, hard assets bid. When silver rises faster than gold, that's usually excitement, sometimes speculation. But when silver falls harder than gold, that often signals stress, because silver tends to exaggerate the mood of the market. So right now, with silver down about 2.5% and gold down less than 1%, the market is basically saying, gold is still the hedge. Silver is the risk. Now, does that mean silver is doomed? No, not at all. But it does mean you should stop treating silver like it's just gold's little brother. Silver is its own beast. Let's talk about the institutional behavior for a second, because this is where retail investors get absolutely wrecked. Big players don't react the same way you do. If silver drops $2 in a day, most people feel panic. They feel like they did something wrong. They start thinking about selling, or they start doom scrolling for someone to tell them what to do. Institutions don't do that. Institutions ask, what caused the move? Was it fundamental or was it flow? Meaning, did the world just change or did the market just temporarily get pushed? And this is the key. Silver is one of those markets where flows can dominate fundamentals in the short run. You can have a strong long-term supply story, strong long-term demand story, and still get slammed short-term if futures traders unwind. So when I see silver down hard and gold down modestly, I'm watching for clues that this was a flow event. Because flow events can reverse faster than people think. But if it's not a flow event, if it's a true macro shift, then silver can keep bleeding even while everyone keeps saying, but the fundamentals. So the real game is diagnosis. And you diagnose by watching what happens next, not by panicking about what already happened. Now let's go technical. And don't worry, I'm not going to talk like a robot. When I say technical, all I mean is, where are traders likely to react? Because even if you don't believe in technical analysis, the people with the biggest positions often do, so it becomes self-fulfilling. Here's how I'd translate today's move into plain English. Silver just proved it can fall fast. That's the message. A 2.5% daily move in silver is not unheard of, but it's big enough to change behavior. It makes traders more cautious. It widens risk controls. It makes the next rally attempt harder because people are quicker to take profits. So after a move like this, one of two things typically happens. Either silver snaps back quickly, and the market treats today like a shakeout, or silver chops and bleeds, and the market treats today like the first crack in the structure. If silver can't reclaim lost ground within the next several sessions, it becomes psychologically heavy. If it does reclaim it, then today becomes the flush that reloaded the spring. That's the battle. And it's why people who only look at one-day moves get trapped emotionally. Now, fundamentals, the real supply and demand picture, matter, but they matter on a different timeline. Silver demand is tied to investment, yes, but also to real-world production. Electronics, solar, industrial applications. That's why silver has these two personalities. Gold is basically monetary and jewelry, with central bank demand being a huge driver. Silver has that monetary narrative, but it also has real industrial pull. So if the market is starting to fear slower growth, silver can get hit even if the long-term thesis is still alive. Because in the short run, traders are not buying the 10-year story. They're trading the next 2 weeks. Now, what makes this tricky, and what makes this moment interesting, is that gold is still holding up relatively well. Gold at around 5,051, down only about 0.6%, suggests the market is not saying we're done with metals. It's saying we're repricing risk. That's the difference. And that difference is exactly why these kinds of days can become inflection points. We've seen this exact pattern before. Let me give you a simple historical parallel, not to predict the future perfectly, but to anchor your expectations. Think back to 2020. You had moments where fear hit the system, liquidity got tight, and markets did weird things. In those conditions, silver was often the metal that overreacted. It would drop hard, harder than gold, because it's thinner and more levered. And then, when the dust settled, silver would sometimes roar back with violent upside moves, because once the forced selling ends, there's less supply of sellers left. Now, I'm not saying this is a carbon copy of 2020, but the psychology is similar. In stress moments, silver acts like the wild cousin at the family reunion. It overdoes everything, so if today was forced selling, the snapback can be brutal. But if today was the market pricing a real slowdown, silver can stay under pressure even while gold holds up. That's why I'm not doing the lazy thing and calling this bullish or bearish in one word. It's conditional, and if you think in conditions, you stop getting manipulated by headlines. Let's make this personal, because if you're watching this video, you're not running a hedge fund. You care about real money, your savings, your purchasing power. So let's put today's move into a scenario. If you hold physical silver, the day-to-day spot price is not the same as what you'd get in the real world if you sold. Premiums matter. But the spot move still affects sentiment, and it still affects the direction of the market. If you've got, say, 200 ounces, a $2.21 drop is roughly $440 on paper in a day. That's a real number. If you've got 500 ounces, now we're talking over $1,000 on paper. So what does that mean for you? It means you need to decide what game you're playing. If you're trading, days like today can wreck you if your risk is too tight and your emotions are too loud. If you're investing long-term, days like today are the cost of admission. And here's the part people hate hearing, but it's true. Volatility is the price you pay for asymmetric upside. Silver is not a calm, polite market. Silver is a market that can make you feel stupid on the way to being right. Now, if you're holding a more traditional portfolio, stocks and bonds, you should still care, because silver getting hit can be a signal about broader risk appetite. It can be the canary, not always, but often enough that you pay attention. So my message isn't panic. My message is use this. Use it as a data point. Use it to check if your position size matches your stomach. Because if you can't sleep when silver drops $2, your position is too big for your psychology. And that's how people get forced into bad decisions. Look, the question isn't whether volatility continues. The math is clear. Silver just told you it can move hard, fast, and without permission. The real question is, are you positioned for what comes next? Because from here, the next phase is determined by whether silver stabilizes and reclaims ground, or whether this turns into a multi-day unwind. Right now, silver is around 81.95. Gold is around 51.51. That divergence is the story. That divergence is the clue. And this is educational content, not financial advice. Do your own research. Consult licensed financial advisors before making investment decisions. These are market observations and analytical frameworks, not buy or sell recommendations. But the data speaks for itself. All right, before you go, 3 quick things. 1. Drop a comment below and tell me where you're watching from. And give me your prediction. Where do you think silver is headed by next week? 2. If you're not subscribed, hit that button now. I'm putting out unfiltered analysis consistently. And listen, I'm fighting copycat channels stealing this content. If this video provided value, comment data over hype so the algorithm knows you're here for the original. 3. Next video drops soon, and I'm covering the one data point that tends to show whether this was a shakeout or the start of something bigger. You won't want to miss it. See you there.